Hey everyone, my name is Mayur Thaker. I'm an equity strategist here at Zacks Investment Research, and this is an important update on the aggregate S&P 500 earnings reported through Q3 2025, and a little bit about what the earnings are painting as far as our outlook for the rest of 2025 and well into 2026. And so far, the earnings have been excellent, and it paints a very optimistic picture for well into 2026. So let's take a look at some of the analytics of what we have seen thus far on earnings reports as well as from management commentaries. So here's a couple of highlights here, and this is actually a typo. Should have written Q3 here, Q3 of 2025. Sorry about that. So the Q3 2025 earnings highlights include earnings growth at double-digit rates. It has surpassed analyst estimates, largely speaking, across multiple sectors. The aggregate number, now that we have most earnings in for the third quarter, over 460 companies out of the 500 S&P 500 members have reported Q3 results now. And on the aggregate, earnings have grown year over year by 15.7%. Blazing hot growth, and that's on the back of very strong revenue growth. Remember, this is important because earnings can come from, a couple of different ways. It can come from, cost control. Cost control is important, no doubt, but cost control runs its course at some point. You can only control costs so much. Definitely very important for companies to be able to do, to be nimble enough to learn to run as lean of an operation as possible. But remember, earnings growth coming from cost controls is not a long-term solution. And so you want to see earnings backed by the top line. And boy, it is backed by the top line. And this has been the case now for multiple quarters. It started really in the early part or mid 2024, and it's carried through uh, into Q3 of 2025, 7.9% revenue growth. Again, very impressive. That is excellent. That is actually very, very impressive for the S&P 500 being as big as these companies have gotten at this point. But remember, a big reason for why earnings and revenue have been so strong is because of the skew that's coming from just a handful of mega cap companies. We've been hearing about this for several years now. The top 10 holdings of the S&P 500 now dominate about 35% of the index. That is a record high, off from the all-time highs set just last year, but still very high nonetheless. But the good news is that this growth that we have seen this year, including through Q3, has come from a variety of sectors. It's not just mega cap technology. These sectors include critical cyclical industries like retail, banks, industrials, and consumer discretionary. Not so much consumer discretionary, but especially the other ones that I mentioned. We are seeing strong earnings acceleration from these sectors. This is very important, and we'll take a look at as to why that's important. But the earnings growth breadth is expanding. It is not, concentrated like it used to be among just the big 10 companies out there. So that's very important to see from a quality standpoint that the earnings growth is being contributed by a broadening number of sectors and companies within those sectors. We have some, good bullish commentary from not only mega cap technology, but also from bank CEOs. That's very important. Banks are a critical cornerstone of economic growth. They are the bellwether of the economic cycle. And right now, bank CEOs are optimistic, and the results have been confirmed to be optimistic. So all of this together has really buoyed markets. It's triggered significant analyst estimate revisions to the upside, and it really sets the tone for 2026. Here's a chart of earnings, and this is what I love to do. I like to show earnings on the aggregate. That's represented by the teal blue line. Again, very strong earnings growth. You can see, north of 15% year over year through Q3. But then if you remove the skew fr coming from the big six companies, right? You can see, throughout most of 2023 and into 2024 almost. If you remove the impact of the big six companies, earnings growth was negative for multiple quarters. It actually started back here in Q4 of 2022. You can see that the black line, which looks at earnings growth of the S&P 500, excluding the big six technology companies, um, was negative. And it remained negative even as the aggregate S&P went back into positive territory, back into positive growth. Now, these numbers were negative even for the total S&P 500, and that's just because we were coming off of very high comps in the year prior to that. Remember, this was the COVID reopening period, so of course, that snapback rally, the sort of revenge travel that everybody went on, all the revenge vacations that everybody went on, that soared earnings to basically double year over year. That is just the knee-jerk reaction to the near depression we had during COVID. So the year-over-year comps got difficult, in 2022 and 2023, and that's why these numbers went negative. But for the S&P aggregate, that went positive pretty quickly. It went positive really back starting in Q2 or Q3. I think, yeah, it's about Q2 of 2023, so it was back into positive territory. But it took the rest of the market longer. We didn't get back into positive growth all the way up until really, well into 2024. It wasn't until about Q1, maybe Q2 of 2024 that the black line really started showing real earnings growth. Even through late 2023, we were basically at zero growth, slightly negative growth there, despite the fact that the S&P aggregate was posting 10% earnings growth back then. So on the aggregate, that looks really good, but remember, that was because of the mega cap skew and the weighting that the outsized weighting that they had on the index. And the rest of the S&P 494 was not doing anything. So if you recall, I was calling a red flag back here because I don't like that at all. I don't like to see just six companies carrying the entire market. You want to see breadth um, to confirm earnings quality. And we started to get that, beginning in the second half of 2024, starting in Q2 of 2024, and really carrying through the rest of 2024. And this has only accelerated through Q3 of 2025. So this is very, very exciting. This is extremely bullish in my view. So with the big six skew included, we're up 15% year over year. And removing the skew of the big six, we're still up now 11% year over year. Again, so that is very, very encouraging to see from a breadth standpoint. So again, earnings are accelerating even outside of technology with critically important cyclical sectors such as retail, transports, um, consumer discretionary, industrials collectively posting earnings momentum. And one of the most important sectors that I just mentioned there is retail, and retail revenue has really surprised to the upside. If you draw your attention to the right-hand side of the chart here, earnings, the beat rate for retail is okay, not great, but not bad either. About 70% of retail stocks beat the earnings estimate for Q3. That's slightly below the 5-year average, so nothing big happening there. It's not terrible, but it's not great either. But the real surprise is on the top line. And remember, in many cases, I would actually argue that the top line is even more important than the bottom line from an analytical standpoint. Why? Because revenue represents demand, right? Earnings is a blend of both demand and cost controls as well as product mix too. Remember, you can have earnings accelerate even without revenue growing and even without cost controls. How is that possible? Well, if you just simply have a shifting product mix, like let's say you sold, like let's say a company like Amazon sold $100 billion worth of goods and they generated $10 billion worth of AWS revenue. But then in the next quarter, they sold $99 billion of goods, but $12 billion of AWS sales. Well, on the aggregate, you really didn't gain that much in revenue, but earnings are probably going to grow by double digits for Amazon in that case. Why? Because AWS is a high margin business and the e-commerce side of the business is a very low margin business. So product mix can also change or have a big impact on the bottom line. And of course, that's important. You want to make sure that's happening. But revenue on the top line is just a raw reflection of demand. How much are your products being consumed on the aggregate? So that is a very, very important bellwether, analytically speaking. And on the top line side of revenue, which is really what drives a lot of retail stocks, is how they're doing on the top line. And 82% of retail stocks in the S&P 500 have beaten Q3 expectations for revenue. That is tracking well above the 5-year average at 66.1%. It's really the highest reading that we saw since the highest reading in the 5-year period here, 95%. And that happened back during the COVID reopening, which really is not a analytically relevant number just because, again, the COVID reopening that was an anomaly, right? It was because of really negative comps in the year prior during the shutdowns. So for us to be beating revenue estimates by this extent, when we're almost, 3/4 of the way done with 2025, with no, extremely, negative or artificially low comps in the year prior period, this is very, very impressive, impressive overall. And they're doing this while posting steady growth, even ex Amazon. So here you can see for Q3, earnings growth for retail was up 18.5% on 8.4% revenue growth year over year. Again, very good. But if you remove the impact of Amazon, obviously the numbers, drop a lot, but still, these are good numbers for retail. 4.2% retail earnings growth, um, and 5.2% retail revenue growth, again, excluding the impact of Amazon. So again, very, very encouraging. So these companies together, between retail, banks, transportation, consumer discretionary, industrials, and materials, together they represent cyclical industries that are analytically relevant as a reflection of the core strength of the US economy. Because we're stripping out the secular growth areas. You want to look at areas that are actually susceptible to the business cycle. That is, the collective, of these sectors that I just mentioned here. That is the core strength of the US economy. And earnings for this group are a leading indicator for US economic growth. This group is well represented by the Zacks cyclical proxy. And here is a chart of that. On this chart, I have here the ISM Manufacturing Index, and overlaid with it is the S&P aggregate earnings growth. Here is that number right here, 15.3% for Q3 year over year. And look at where cyclicals as an aggregate group are. We have now finally left. This is a narrower group. Remember, earlier I showed you S&P 500 minus the big six companies. That's been, positive and accelerating for over a year now, almost about 6 quarters now. But the cyclical sectors, the truly cyclical sectors, right? This is a smaller subset of companies of the S&P 500. They were actually negative on a year-over-year basis in terms of earnings until Q3. This was the first time since late 2022 when earnings for this group was positive. on a year-over-year basis. This is a very, very important analytical trend to watch because this is telling us that the earnings momentum that we have seen for the S&P 500 is broadening out to very, very key components of the economy, areas that traditionally are very, very sensitive to economic cycles. You can see that the green line starts to move down ahead of recessions. In most cases, you can see that they go negative ahead of recessions in many cases. It went, negative ahead of this recession. It started weakening during that, 2008 period. It started weakening well ahead of the 2020 recession. And, it was actually negative for almost all of 2023, all of 2024, and half of 2025. And so that was a negative, very, very negative period for cyclicals. That's why I was calling the recession back in 2023 or 2024. But this has really turned a new chapter, and we are now back to growth. So again, this is very, very encouraging. And so if you look at it, 7 out of the 9 cyclical sectors remain in expansion, driven by steady top line growth. You can see that right here. 7 out of the 9 are growing. The only two that are not growing on an earnings basis are consumer discretionary and construction. Construction, you can actually make a case for that just because they're coming off very strong comps on the year-over-year basis. So really, the only sector that's seeing weakness right now, is consumer discretionary, and I hope that does turn around. But on a top-line basis, all 9 sectors are in expansion. You can see consumer discretionary revenue growth is positive 2.6%. And none of the other, cyclical sectors that I mentioned here are in contraction on a top line basis. So that's again very, very important from an analytical standpoint. And cyclicals are expected to materially accelerate in 2026. Here you can see that estimates for 2026 call for a significant acceleration. So this is continuing the growth trend that we started to see, um, in Q3 this year, Q3 of this year, 2026. That trend is expected to accelerate well into 2026, and analysts are currently bullish with a forecast of 17% growth on the bottom line for this group of very, very important companies in the cyclical proxy here. If this happens, this is very optimistic. This paints a very bullish picture for the market, and it really just suggests to me that dips will be bought. Further, banks report very robust earnings driven by deal making, as well as reduced loan loss provisions. That's very bullish too. JP Morgan, Bank of America, Wells Fargo, Morgan Stanley, Citigroup, and Goldman Sachs all reported increasing momentum on the deal making side of the business in Q3. This is also a key gauge of overall macroeconomic sentiment, since M&A typically only happens when attractive growth opportunities exist at reasonable valuations. Financials have posted 8.7% revenue growth and 23% earnings growth year over year, with a blended beat rate of 73.3%. This is really the best results we've seen from this group in several years. Further, regarding loan loss provisions, JP Morgan, they lowered their full year net charge-off rate forecast. Bank of America reported credit card charge-off rate declined from 3.82 to 3.4%, while also commercial real estate non-performing loans declining 19% versus Q2. Again, very, very good for the state of affairs of consumer finances and the household debt service ratio, things like that. It's a good reflection on the state of the financial health of the consumer. Wells Fargo reported large decline in its provision for credit losses too. They had 1.86 billion provision a year ago. That's been revised down by 40% almost to just 681 million this quarter in Q3. Others, including Capital One, American Express, and PNC, all confirmed this healthy trend. Again, this is very good to see from a consumer standpoint. Again, since consumers are directly tied to retail sales, which is such a massive part of the US economy, seeing declining loan loss provisions is a direct reflection of the rate of change of the financial health of the American consumer. So again, very important to see. So overall, earnings are expected to stay robust into 2026. I am personally not seeing anything from an analytical standpoint. If you slice out key cyclical sectors, if you slice out the impact of the big six companies, everything is pointing to the right direction. And so overall, earnings are expected to remain robust into 2026. 11% earnings growth on 6.7% revenue growth. Again, very, very bullish overall. So the key takeaways though, the S&P is not cheap. It does trade at a highly elevated 23 forward PE, with very bullish growth expectations next year. That bar, again, at this valuation is extremely high. It is in the top decile over the past 40 years. As such, the forward earnings yield of the market is kind of close to parity with the 10-year yield. Historically, market returns over the following 5 years have been poor at these levels, but we would need to see earnings growth continue coming in at double-digit pace to support the market at its current valuations, and that could very well happen. If the underlying trends that I'm seeing continue, we could see earnings continue to support the market at these valuations. And that's really the reason why market momentum remains exceptional, with indices still within 5% of the all-time highs. So, strategically, tactically, what would I do? I would remain long the S&P 500 as long as it remains above the 10-week average true range. This is a technical indicator that factors in volatility and standard deviation of the market, which currently sits at 6409 for the S&P 500. So if we get a weekly close, like a Friday closing below that number, 6409, we're still, a healthy ways away from that. But if we get a weekly closing price below that level, I would go defensive, primarily because we're coming from a very elevated PE multiple. So even though the earnings trends are positive, you just never know what can come from left field to derail this earnings momentum. And because we're at a elevated PE multiple, the risk to the downside remains very high. Remember, earnings are oftentimes a coincident indicator. So sometimes, we could have strong earnings even during recessions. Because remember, the recession is only known in hindsight. It's only called in arrears. It's called much later. Um, and so by the time earnings, start heading in the wrong direction, the market could have already priced that in very much in advance. So it's always important to remain vigilant. If we are at an elevated valuation, which we are, objectively speaking, then it's always important to manage risk. And I believe that the 10-week average true range, it's a weekly frequency chart that I use. If we follow this and we manage risk in this way, you can participate in the vast majority of the upside while eliminating a significant portion of any major market downturns. This is a phenomenal way to manage risk while participating in the majority of the bull market. So right now, that level, that critical, important level is 6409. Again, if we get a Friday closing below that level, I would get defensive very quickly, even though what I just told you is very bullish from a fundamental standpoint. There's always the unknown, right? And because we know that the market is very rich, the bar is very high right now. So if something comes in that disappoints, it doesn't even have to be a recession, but if there's some disappointment, if it turns out that we are in an AI bubble, if it turns out that CapEx slows dramatically for AI spend, which impacts earnings in a negative way very abruptly, then the market will reprice itself very rapidly. So that's why we always want to manage risk no matter what. So 6409 is the level. But in my view, the best gains are going to come from high quality companies with strong balance sheets, high ROIC, and attractive valuations. So refer to the Zacks Earning Certain proxy and the Zacks Deep Value proxy for a collection of these companies. Here are some of the top ideas I have in the Zacks Deep Value proxy. Especially Albemarle. I'm a big fan of this company right now. But these are some of the companies. There's many more. So if you are interested in this portfolio, these are companies that I've seen experience significant multiple contraction, and I believe are now priced very attractively relative to the growth forecast that they have over the next 5 years. So the gains from these companies are going to come from a combination of earnings acceleration, amplified by multiple expansion over the next 5 years. So that's a very powerful combination for market beating returns over a 5 year period. So if you are interested in this portfolio, please do reach out to us. I'd love to hear from you. Any feedback or questions, please do call us at 1-866-794-6065 or send us an email to strategycall@zaxpro.com. All right, thank you everyone, and just talk to you soon. Bye.